Welcome everyone. We begin with the book, The Best Investment Advice I Ever Received. In every video, we will focus on the advice given by 5 personalities and interpret and explain them in simple terms for you. Let us begin. The first personality is none other than the legendary Warren Buffett. When he speaks, everyone listens. And with good reason. The author of the book, Liz Clayman, has written about 3 principles of Warren Buffett. Let's go through them. The first principle is that Buffett does not buy sectors or ideas. This means he does not get crazy about sector prospects or ideas that are in the limelight. He only buys companies. If a company's fundamentals and future prospects attract him, he invests. It does not matter what sector it belongs to. But before buying, he tears apart every aspect of the company. This diligent research is most important because it brings conviction in investing. This is something you must absolutely bring to your investing as well. His second principle is with respect to investor attitude towards the market and market fluctuations. Firstly, he does not let what the majority is saying dictate his actions. Irrespective of the attitude people have about the markets, he goes on in his own way. The 1990s dot-com bubble was a perfect example of this. Everyone was going after internet plays. They were making millions, and they were mocking Buffett for being old and out of touch. Yet Buffett did not care. Today, he is still the leader of the pack, while the rest have faded away. Secondly, he does not care about day-to-day movements of the market. He advises that an investor should ignore these fluctuations because good companies can handle volatility. In the long term, good companies stand tall. The final principle mentioned by the author is that of margin of safety. Buffett says that no one can accurately calculate the actual worth of a stock. We can only estimate what the real valuation might be. So, he advises to buy companies that seem significantly below their actual valuation. Let us take an example. You calculate the worth of a stock to be in the range of 100 to 120. If the stock is selling at 80, you should buy because there is a significant gap between the current price and your estimate. Even if your estimate is somewhat wrong, you still have a margin of safety and a good chance of ending up with a profit. We now look at what James Awad has to say about investing. He is the chairman, president, and chief investment officer of a successful asset management company. An advice he was given by his father was, don't trust anybody who is glamorous and flashy and claims to have a secret formula for making money. He then narrates a real-life episode. Early on in his career, he was offered 2 jobs. One from a hot mutual fund that bought small-cap companies. It was the number 1 fund in the US. The other was from a traditional investment counsel fund company that paid less. Based on the advice of his father, he took the second job. Few years later, the first company went out of business. The lesson is to be pragmatic. Don't run after what is always flashing in the headlines. Once James was researching land development companies. He came about a stock whose price was just $10. He met the president of the company, who said they were going to report earnings of $4 per share in the coming days. That is a P/E ratio of just 2.5. The president then told him that a big block of stock was up for sale. James was excited. He went to his boss and told him about the company. His boss said, if it sounds too good to be true, it is not true. Few days later, the company reported numbers. Not earnings, but a loss. And its stock fell rapidly. The lesson is to not blindly believe everything people say, especially if it sounds too wonderful. Be patient and take your own decisions. In 1973, America was in a massive bear market. It lasted for 2 full years. The S&P 500 index fell from 116 to 68, a fall of 41%. The mood was extremely negative and pessimistic. It was then that his boss gave him an advice. He said, "Always have greed when others are fearful, and have fear when others have greed." The index went from 68 to 108 in the next 2 years. Those who had kept faith and put money when the markets were down made incredible wealth. The lesson is to keep your emotions aside. Focus only on the fundamentals of your investments. Stanley Bergman is the chairman and CEO of the company Henry Schein. Let us see what he has to say about investing. His first advice is to invest in companies that are in good markets or sectors. The market in which the company functions should have good future prospects. It should be able to move through bad times and emerge stronger. You must study the factors that can affect a sector and thus the company. Let us take an example. An aging population, like in Japan, will have an impact on markets that cater primarily to the youth. Thus, the companies working in such an environment will naturally see slower business. The second piece of advice is to put money in companies that have great people and great values. As an investor, it is important to put more focus on the people running a company than its assets. And so, you must look at the management of a company. Study their credibility and past performance. The third advice is to invest in companies that reinvent themselves. The world is changing rapidly. Companies that do not change with changing times become obsolete. If we take today's market scenario, there are certain sectors that are regarded as markets of the future. Like renewable energy, electric vehicles, semiconductors. Companies have a great chance of becoming major players in these sectors if they can reinvent themselves according to the requirements of these markets. Let us see what Richard Bernstein has to say on money management. He is the chief US strategist for Merrill Lynch and Company. The first advice he mentions that was given by his father is, "Save a lot and save often." Richard writes that there are Americans whose credit card balance is more than their annual savings. Their credit card balance compounds at 9%, while their investments give 8%. They are not saving but losing money. Don't be satisfied by just meeting your expenses through your salary. If you don't save, you are putting yourself at great financial risk. His second observation is that debt actually hampers wealth creation. It gives the illusion of having wealth that is not actually there because you eventually have to give back the money you have taken. It is important to understand that living for today on debt is the recipe for financial disaster. Savings and consumption don't go hand in hand. Do not be fooled into the misconception that you can save properly as well as spend with an open heart. If you consume today, you are reducing your wealth for the future. If you save today, you are reducing today's consumption, but have opened up the possibility of much greater consumption in the future. Scott Black is the next expert we talk about. He is the founder and president of Delphi Management. His first great learning is that one should invest in companies with high return on equity and low price to earnings ratio. He mentions Warren Buffett, who gave a lot of importance to high return on equity because a good business should have the ability to generate high returns on its equity. You should keep in mind these two fundamental aspects while analyzing companies for investing. The second piece of advice is very significant. Do not time the markets. Timing the market means trying to sell at highs and buy at lows. Remember that highs and lows are for fools, and nobody can accurately estimate both. The key to long-term wealth creation is buying and holding. If you keep trying to constantly sell and buy, you are not investing, you are merely trading. This way you will never be able to reap the benefits of compounding because it only works if you are continuously present in the markets. The last piece of advice is equally important. Do not chase fads. A fad is anything that is in fashion and has everybody going after it. Most often they are temporary, and when they make an exit, they take your money with them. When something is hot in the markets and everyone is buying, the valuations get exaggerated. And then the bubble bursts. In the current environment, the one area where this might be happening is cryptocurrency. Whether cryptos are truly a fad or not is something only time will tell. In the next video, we will take up another 5 experts and interpret what they have to say about the financial world.